First, I would like to thank Daniele and the entire Diamond team for their invitation and meeting such a joyful and active audience and speakers. I would like also to thank my old friend Paul for making the best introduction to my talk, because I'm going to show you the limitations of classical portfolio management and the Sharpe ratio. And let's start, because we don't have much time, so let me start right away with the classical hedge fund analysis. So the talk is essentially focused on selecting hedge funds. Why hedge funds? Because everything that is non-traditional, all the shortfalls of classical linear analysis, they pop up here like, with a zoom in this industry. They are very non-linear assets, but everything I say here would be valid across the board in investment. Whether you invest in commodities, in equities, even more so in bonds. The most nonlinear assets are the bonds themselves. And here is the list. So Sharpe ratio, as you can see, it's on top of the list of what people use to evaluate the performance of a fund. But you have plenty of them. So to say, well, I have problems with the asymmetry. So I use the Sortino ratio, where you only use the volatility on the downside. Or I want to see, the real drawdown. So I use this CalMAR, which is California minimum accepted risk. The pain ratio, I like it a lot as a measure afterwards. Which is, how much in average you are below your previous high watermark. Very related to this happiness that Paul was mentioning. The omega ratio, which is, where you should put the bar so that the puts are equal to the calls. And plenty of things, that are, Morningstar is having their MRR, utility functions, etc. All those things. What do they have in common? And why you get a problem? Because they are good afterwards. If I see something afterwards and I see a certain measure, I can say, yeah, the guy did a good job or didn't do a good job. I have no clue of whether that good job, with quotes, was skills, luck, or simply just the right thing to do at that moment, and whether the guy is going to do the same thing in the future. So let me show you a few critics of the Sharpe ratio here. I'm going to go a bit fast on those, but these are you see, I had a database of hedge funds which I sorted out. I eliminated all the duplicates, etc. So there are about 3,000 funds that were quoted. And I calculated the Sharpe ratio over the period 2004-2006, that's 3 years. And I looked on the y-axis what it gives the next year. And so if you select funds with, let's say, a Sharpe ratio above 1. So this is 1. This is a half. And you see, that you get some positive expectations. Okay. Let's see what happens the next year. Of course, the year of the crisis. And the year of the crisis, the best Sharpe ratios were also an assured loss in the future. Why so? Because the people who were doing arbitrage and were showing nice Sharpe ratio, they were completely blown up by the crisis. Okay, that was, crisis doesn't occur every year, so let's try to do something else, like the next year. So now I include the crisis in the calculation, and I'm looking at the rebound year, 2009, and that's even worse. So it just shows you, that as soon as you have some change of regime. Those questions, those past measure, they don't apply to the future. Here is same thing, I like this slide because it shows you during the crisis. So this is the volatility calculated over this period, January to December 2007, and the amount of the loss in 2 months, September and October 2008, so the crisis, in number of sigmas. So you see that you get some of them that you really lost a lot. These are not 1, 2, 3, 5, it's 5 sigmas, 10 sigmas, up to 30 sigmas. Just to give you the size of fat tails, which I think, sorry, I mean, Paul, you know my stuff, so you know that I'm very much focused on fat tails, change of regime, that's what I'm going to say. So how do we address that? So let's see, I like this one. Let's see, how do we do? Factor analysis is something that, tells you I have a fund and I'm looking at its sensitivities to different factors. And I'm trying to mimic the fund as a combination of a fake portfolio made of factors. And if I have some views on what the factors are going to do, I can see there. The difficulty is a trap in between. If we have sufficiently many factors to describe all the things, then I have a very high likelihood of being overfitted on the past. So the future will not look like the past. If I don't have enough factors, I may miss the point. And the second thing that we will see here is that the question of multi-factor is almost secondary with respect to the question of asymmetries, question of different reaction on the upside and the downside, so nonlinearities. What is nonlinearity? It's a different beta, whether you go up or you go down. And those different betas, it's like a change of regime where you say the correlation changes. But correlation doesn't change like you drop a coin and, oh, here's a new correlation. If you have a move of 1%, you get a certain correlation, 5% you get different correlation, 10% you get different correlation. This is systematic. This systematic change of correlation, in mathematics, it has a word, it has a name, it's called nonlinearity. It's a change, exactly like an option where you change the delta of the option. So, yeah, here is to show you, to emphasize that. The reaction is still the 2008 crisis. Why do I speak of the 2008 crisis? I think it's very relevant today. What may happen, we're in a world where the market holds, a bit like, the guy who is walking, those cartoons when you get the coyote is walking on above the cliff because he doesn't realize he passed the cliff. And there is a risk of dropping. There is also the adage saying that the market can stay wrong more than you can hold the position. So, and we're in between. We're in this type of speculative bubble on AI that we spoke a lot of, very similar to what happened on internet bubble in 2000, where we know that some of them will survive. There is true value in AI. At the same time, some of them will drop massively, and so we are just in the unknown period where we don't know, what will. And here you see, the typical multi-factor analysis that were applied, and the x-axis is the real performance of the funds during the crisis. So actually, just September 2008 here, and the y-axis is what they would have done if the factor loadings had been constant, that had been respected, that during the crisis was the same as before the crisis. And you see that the upside, at least you get a positive correlation. It's not very precise, but definitely the downside is missed. So that means that the fund did not, the model did not capture the real risk of the funds. Funds could lose up to 60%, whereas they only measured less than 20%. So, okay, I'm going fast on the data here. I want to emphasize here something about what I call panesthetic analysis. So you can look in the word, you won't find that word. I just coined it myself by putting together some Greek roots. The idea is, you want to describe something. And in here, so, Paul was showing, you take, the expectation, the risk, very much in mean variance logic. And in fact, what you need to know, if I'm the captain of a boat on a very stormy ocean. So my question is not so much, what how what the volatility of the stability of the boat. It's how the boat reacts to the waves. I need to know that because that's as my role. It's the role of the weather service to tell me you are facing a storm, etc. My role as a captain is to know how my boat is going to resist to waves of different sizes. So what is missing in the classical phenomenology is what I call the behavioral cause. It's not to know what is in the fund, why is the fund has been, how it is, what's the logic behind the construction of the fund. So this would be what is in the fund, the content. That was, the logic for the math to create the fund. That would be, the purpose, the utility function that you apply. In here, it's simply empirically, if the market is different aspects of the market move, what are the expected impact on the fund? So you see, panesthetic analysis is the fundamental idea that you are dealing with objects that are embedded in an environment. That environment is financial markets. And you want to describe things as a series of stress tests. So what if analysis, but the what if not in terms of content, but in terms of scenarios. In fact, everybody does that. There is nothing new. There is nothing revolutionary. To do it, actually, we do it. We just didn't absolutely coin the thing. So people will rely and will have, some models and Black-Litterman, etc. models. But to really control things, they monitor their scenarios. They monitor their what if. So there is a... the contrast with decision theory, you see the decision theory will, overlook the hidden variables, the nonlinearities, the secondary effects, which you cannot avoid if you historically look at how things happened. We are a lot trading cryptos here. Okay, you get a new cryptos coming, and it's a bit the same story as I'm a young driver, just got my driving license, and I go to the insurance company and says, look, I never had an accident, so you should sell me a very cheap insurance. And the insurers tell me, my dear friend, I have 2 million young drivers. I know exactly the statistics of how much accident you are going to have in the near future. And it's higher than an old driver who has lots of experience. So you see, this calculating the best you can with available information. If we know that systematically when a crypto is issued, you get this rise and this drop, etc., then a new crypto is issued, first assume that it will do that. And maybe you have some reason to think that it will be something different, and by what aspect. So how do we do that? Well, all of that is what I discussed, the regime shift and the change, the missing environment information. The panesthetic analysis is about, this practical application. And in here, I'm going to show you, so polymodels is the implementation of this. So you create a risk profiling, so that's this list of stress tests. You use, historical memory, all the past events that you know, and then the good thing about it is that if I have the same list of stress tests across different assets, then I can aggregate and see whether I'm still diversified through extreme scenarios, etc. So I won't get surprised by, change of regimes, etc. So how do we do that? Okay, again, I pass fast on that, but suppose that we get a phone with a very nice performance, and this is a simulated phone, and this is, what happened next. And can we anticipate the red curve, knowing the black curve? That is, you see, something that past analysis would never give you. And the answer is yes. This is a simulation where I created a fake phone that is essentially tracking the credit spread, the investment grade credit spread. So I take the investment grade credit spread and I calculate 20 years of fake history of that phone based on the knowledge of the black curve here. And you find out that those losses did occur many times in the past. So this should not be a surprise. I'm not saying it will occur. I'm just saying it shouldn't be a surprise. It's in the books. And what was a surprise, on the contrary, was that rise that was twice as much as what we ever occurred. So here, okay, I pass fast on this one, but to show you the impact of nonlinearity, you see this long-short equity. It's a famous fund, but I won't tell you the name. The upside is almost pure alpha, but it has a very strong downside, which is pure beta. So if that fund is telling you I have limited beta, slightly long bias, etc., it's wrong. This fund is selling a put. It turns out that on the long run, it's not bad because the alpha is strong enough to compensate for the sale of that put. But you better know as an investor that when you have market drawdowns, this fund will multiply the market drawdown by 3. It's not small. So polymodels, it's a technique where you can scan many, many factors. I'm talking of hundreds to even thousands of factors. Of course, there is no possibility to make a multi-factor analysis. So you do that one at a time. And you deal with a collection of single-factor models better than a multiplication of multi-factor models. That collection is extremely informative. It tells you for each fund what are the biggest risks, what are the scenarios that can impact the fund. And then from there on, I can take, okay, I go fast, but this is the idea of the panæsthetic representation would be a given list of stress tests that I base for my portfolio construction. This selected list of factors is the polymodal representation, and for every factor that I'm moving here, I can find those factors who correspond to this stress test that I want to do, and find the most informative factor within the polymodal information. So that's why I call maximizing the information ratio. And that gives you probably, the most accurate. What is the consequence? When a mean variance analysis is wrong because of a fat tail event, they can be wrong by a factor 3, 5, 10. You saw it. This can be wrong. And it's even in normal cases, it will not give you something extremely accurate. But it's accurate up to about 20% error. So it's accurate 20% error in normal conditions and 20% error in extreme conditions. Believe me, that is very, very informative. Just so I go fast and because I have little time, let me go to the conclusions and to show you. First of all, selecting the best factors by information ratio. Now, this is what it gives during the 2008 crisis. 90% correlation between predictions and actual performance. This is, of course, due to the fact that during a crisis, you have what you call a tail concentration effect. Everything becomes correlated. So a single factor is efficient, provided you take the nonlinear approach. This is, to show you the efficacy. This is, certain risk measures that I use. Won't go into the formulas to calculate, the risk. The expected alpha, which I call it alpha. Actually, it's not really an alpha. It's take, the factor representation with the nonlinearities and extrapolate, like I showed, over many, many years. So across an economic cycle. So you have no particular view on what will be the future. And this is a pretty efficient way of anticipating, and so gives you an unbiased view on which you can introduce your own views, like in Black-Litterman, but it gives you, some unbiased view on what is likely to do, so to sort out what is beta and what is alpha. So that is, the typical, best factor fitting of hedge fund versus, so it gives you, how to anticipate the fact that if I find this factor with nonlinear fitting of that hedge fund, so here is a small cap USA versus a corporate credit arbitrage. You see, there is no reason there is equity risk. Of course there's a credit arbitrage. There is equity risk. We know it. And you know that this one is also, again, selling a put. So it never lost more than 2%. But should you have a drop of 15%, which occurred in the past with 99% confidence interval, then you would see potentially a loss which is twice as big. Not huge, but better to know it. Here is, so the simulation is to take the list of all the hedge funds. This is a Eureka Hedge database. All the hedge funds in the world that are quoted in the database. If I make no simulation, this is simply the hedge fund index. So cap-weighted hedge funds. The purple curve is using a classical Morningstar rating. And you see that, in the rally periods, it's make it, but when you have a crisis, you are full speed in funds that drop a lot because you are only analyzing this way. And you see, this is a log scale. You see 100, 200, 400, 800. So this is log scale. So you see that the size in here, you are losing about 10%. Here, it's more like 15 or 16%. On the contrary, if you use this polymodal analysis that accounts for the nonlinearities and the overreactions, then on top of that, I put a filter where I only select funds who have what I call a positive gamma, so they tend to have a bigger reaction to the upside than on the downside. So I avoid those fragile funds. I only take what Nassim Taleb calls the anti-fragile funds. And you see that, first of all, you don't see the crisis. The COVID crisis itself, which was very much of a statistical surprise, is also divided by 2. That's about 5%, but this is 9.5%. And we still keep, the upside. We keep the alpha of the funds. Hedge funds, supervised learning is to use the output of polymodels as a feed to neural networks to make a better selection. And machine learning, what to expect, is essentially, saying that we can believe in Santa Claus by saying, okay, well, the machine will tell us where to invest. I doubt. But I remember once I was in a conference with Kasparov was a guest speaker, and he was saying that, telling that story, sorry, I'm taking a minute to say that story because I like it a lot. He was saying one day there was an online contest in chess, and it turned out, he said, well, it wasn't foreseen by the organizers, but the best players in the world, there was Anand, Kramnik, himself, etc., Karpov, they just registered in it. So there was a top-level players, chess players in the world in this contest, and none of them won. Also, I think there was Deep Blue also where we came in, and he didn't win either. The guy who won was a pair made of good but off-the-shelf software, and a guy who was a good, international master, but not at the level of the Kasparov people. And the two of them, one was having the human intelligence and the intuition. The other one was basically what's the machine doing? Avoiding, making stupid mistake that in five moves you would lose massively. So I think, machine learning is a bit the same thing if you want to do it efficiently in finance. You need to have the machine, because believe me, when you do a systematic strategy, it's very difficult as a human to beat it. I mean, it's you do have very efficient systematic strategies, but those systematic strategies, to be implemented, to be understood, etc., to know where it goes, when to run it, when to serve, then it's human intelligence. And that's my last message.
Thank you so much, Raphael Douady. Thank you. It's man plus machine, my understanding of your latest message. And interesting because there was this prediction that chess based on automation will go out of fashion. Chess has never been so popular because nobody watches two machines watching together. And today there are series, on chess players and so on. So it's very popular. And thanks again for your analysis. Really grateful.